Hey there, fellow investors. Today, we're going to talk about a common mistake that many investors make. So, let's dive right in. One of the biggest mistakes investors often make is focusing too much on the past. We tend to get caught up in the hype of how a company has performed in the past, rather than looking at the future potential. When it comes to investing, being aware of common mistakes is crucial to avoiding significant financial pitfalls. The reality is, many investors fall prey to simple errors that can cost them dearly in the long run, and it's essential to know what to watch out for. One of the central challenges investors face is overlooking fundamental principles of investing. This can lead to a multitude of costly errors, from failing to diversify their portfolio to getting caught up in emotional decision-making. It's easy to get caught up in the excitement of making a quick profit, but it's essential to stay grounded and focused on the bigger picture. By neglecting these principles, investors can find themselves making impulsive decisions that ultimately lead to financial losses. Furthermore, this lack of discipline can lead to a cycle of fear and greed, causing investors to make rash decisions that hurt their long-term goals. Additionally, without a clear understanding of these principles, investors may fail to adapt to changing market conditions, leading to stagnation and missed opportunities. It's not just a matter of understanding the principles, though. It's also about putting them into practice. Many investors get caught up in the excitement of a hot new stock or investment opportunity, failing to do their due diligence and research. This can lead to a lack of diversification, where an investor's entire portfolio is tied up in a single investment, leaving them vulnerable to significant losses. Emotional investing is another common mistake, where an investor makes decisions based on how they feel in the moment, rather than on careful consideration and analysis. Ignoring diversification and failing to do adequate research are just a few examples of the costly mistakes investors can make when they neglect fundamental principles. One of the most impactful mistakes that many investors make is failing to have a long-term perspective. In a world where we're constantly bombarded with news and updates, it's easy to get caught up in short-term thinking and make decisions based on fleeting market trends. For example, let's consider Apple. Yes, it's an incredible company with a strong track record, but if you're only looking at the past, you might miss out on the potential for growth and innovation that Apple has to offer. So, remember to keep an eye on the future when investing. Don't be afraid to take risks and look for companies with the potential to make a difference. Thanks for tuning in, and don't forget to follow and subscribe for more investing tips and insights. Stay smart, stay invested.